You know that feeling, right? You want to invest, but you're just frozen. You're terrified you're going to jump in at the absolute worst time. Well, today we're going to smash that fear. We're breaking down one of the simplest yet most powerful ways to build wealth, the Systematic Investment Plan, or SIP. This one's for anyone who wants to invest smart without all the stress.
Okay, let's kick things off with a question that honestly messes with almost every new investor's head. So, you buy a share for 100 rupees this month. Next month, it's 110. And that little voice in your head just screams, wait, why would I buy it now? It's more expensive. I should wait for it to drop. It sounds logical, right? But I'm telling you, it's probably the single biggest trap in investing.
And that question, it really comes from a deep, paralyzing fear. It's not even about losing money, not really. It's the fear of buying at the perfectly wrong time. We get obsessed with trying to time the market, waiting for that one magical moment to invest, a moment that, let's be real, almost never shows up. And that endless guesswork is why so many people's investment journeys never even get off the ground. But what if there was a way to take all that guesswork, all that anxiety, and the need to be some kind of market genius completely out of the equation? Well, there is, and it's called the Systematic Investment Plan. It is such an elegant solution to this very human problem.
So, what is an SIP exactly? It is dead simple. It's basically a promise you make to yourself to invest a fixed amount of cash, say 5,000 rupees, on the exact same date every single month into a fund you've chosen. And here's the key. You do it whether the market is flying high or taking a nosedive. You just stick to the plan. Now, that might sound almost too simple to work, right? But the real magic is in that relentless consistency. Theory is great, but let's look at a real-world example and see how this simple act of discipline can turn into some serious wealth.
Okay, so for our case study, here's the setup. We're going to track a real investment of 5,000 rupees going into the Parag Parikh FlexiCap Fund every single month. And we're going to watch this journey play out over 8 years, from May 2013 all the way to June 2021. The only goal here is to see what happens when you just stay disciplined.
So let's follow the fund's NAV, the net asset value. You can just think of it as the share price for the mutual fund. Back in 2013, it started around 10 rupees. By 2016, it had grown to 18, and by 2021, it hit 45. Now notice, it wasn't a nice, smooth, straight line up. Of course not. There were plenty of bumps and dips along the way, but the overall trend, well, that shows some powerful, undeniable growth.
All right, so over those 8 years, putting in 5,000 rupees month after month, the total amount of money that came out of your own pocket was 4,90,000 rupees.
So you put in 4,90,000. And what did that become? Get this. By June 2021, the value of that disciplined investment had ballooned to 11,60,000 rupees. Yeah, you heard that right. Your money more than doubled.
This chart just says it all, doesn't it? That first bar, that's your total investment. The second, much taller bar, that's what it grew into. And that huge gap in between, a profit of over 6,70,000 rupees, that wasn't made by being a stock market genius. It was made by simple, boring, consistent discipline.
And that's the whole secret sauce right there. See, when the market was down, your 5,000 rupees bought more units of the fund. When the market was up, it bought fewer units. Over time, this automatically averages out your purchase price. It's a powerful idea called rupee cost averaging, and it completely removes emotion and guesswork from the equation. But you might be thinking, what about the alternative? What if I get a big pile of cash and I'm tempted to just dump it all into the market at once? Let's put the disciplined SIP approach head-to-head with what I call the lump sum gamble. Just imagine this scenario for a second. You get a nice bonus in August 2018 and you invest 5 lakh rupees all at once. Then, just over a year later, March 2020 happens and the market crashes hard. In a flash, your investment could be down 20%, maybe more. Your 5 lakhs is suddenly worth 4. I mean, that is just a brutal, soul-crushing experience for any investor. This slide just lays it out perfectly. The SIP is like the tortoise in the story. It's slow and steady, and it smooths out the bumpy, volatile ride of the market. You're protected from that nightmare scenario of putting all your cash in right at the top. A lump sum investment, though, that's the hare. It's a huge gamble on timing. Get it right, you could do great. But get it wrong, it can be absolutely devastating. Okay, so we've established that SIPs are a really smart, disciplined way to go. But now it's time for a pro tip. There is one crucial little detail that can seriously boost your returns over the long run, and it's something that so many investors just completely miss.
Okay, listen up because this is important. When you invest in a mutual fund, you've got two options, a direct plan or a regular plan. A regular plan means you go through a middleman, like a bank or an agent, and they get a commission. And guess where that commission comes from? Your investment, through something called a higher expense ratio. A direct plan, on the other hand, lets you cut out the middleman. You invest directly, there's no commission, the expense ratio is lower, and that means more of your money stays in your pocket working for you.
And here is the absolute crucial point. That little difference in the expense ratio, maybe it's just 1%, that's not a one-time fee. Oh no, it is a charge that gets sliced off of your investment returns every single year. Over 10, 20, or 30 years, that seemingly tiny percentage compounds into a massive amount of your hard-earned money that just vanishes into commissions.
Now let's circle back for a second. What if you do get a big lump sum chunk of money, like from a bonus or an inheritance? We already know that just throwing it all into the market at once is super risky. So is there a disciplined way to handle it? You bet there is. Here is the SMART Playbook, a simple 3-step strategy. First, you park the whole amount in a safe, low-risk debt fund. It's a type of fund that's way less volatile. Step 2, you set up a systematic transfer plan. It works just like an SIP to move a fixed amount from that safe debt fund into the stock-based equity fund you actually want to be in, month by month. Finally, once that lump sum has been slowly and safely invested, you just continue the SIP with your regular monthly income. It gives you the best of both worlds, the safety of not going all in at once, and the discipline of entering the markets systematically. So let's do a super quick recap of what we've learned. SIPs are all about building wealth through discipline, not by trying to be a market psychic. They automatically average your cost, which is a fantastic way to slash your risk. We saw in a real-life example how this simple discipline can more than double your money in just 8 years. And, so important, always choose direct plans to keep more of your own money. And finally, you can even use the discipline of an SIP to invest a big lump sum safely and smartly. Which brings us to the final question. And honestly, it's one you have to answer for yourself. After seeing all this, are you going to keep playing the stressful guessing game of trying to time the market? Or are you going to embrace the simple, proven, and frankly, much calmer power of discipline? The choice is all yours.